Hi, everyone, and thanks for joining me. There's been a lot of news and market volatility over the past couple of weeks, and I know it's top of mind for many Canadians. I want to spend a few minutes walking you through what's happened and how our team is approaching the situation to manage these events within our funds. It's been an eventful period that has received continuous coverage. The catalyst was on February 28th when US and Israeli forces carried out joint military strikes on Iran. The immediate market reaction was what we typically expect in a knee jerk response to geopolitical shocks and events. But since that initial shock, much of the focus has been centered more on a potential disruption to energy supplies. And what we're seeing now is the market trying to price in the duration of the conflict, which remains the key uncertainty. Our framework is built to withstand shocks like this. First and foremost, we focus on policy, not politics. Our job isn't to predict the next political move, but to analyze the economic and market implications of events as they unfold. We look at the potential impact on corporate earnings, inflation, economic growth, and asset prices. Second, we lean heavily on our deliberate research-based framework. One of the pillars of that framework is sentiment. In practice, this could mean we aim to take advantage of market fears rather than indulging them. We look for opportunities when sentiment becomes overly negative. For example, our asset allocation research team has noted that for now, the fundamental picture of the US business cycle remains in a mid cycle expansion, and we remain cautiously optimistic on Canada as well. It would take a much more significant and sustained shock to oil to change that base case. So our approach is to remain disciplined, filter out the noise, and focus on how these events are or are not changing the underlying economic and market fundamentals. This is where our philosophy translates into tangible portfolio construction. Our primary goal is to build resilient portfolios before a crisis hits, so we aren't forced to react in a panic. The key to this is diversification. But we believe in evolving beyond the traditional 60-40 portfolio. With the correlation between stocks and bonds having increased, we've been deliberate in adding other exposures. Specifically, here's what that looks like in our funds. Gold. We hold gold as a strategic position. We see it as a direct hedge against geopolitical uncertainty and potential US dollar debasement. And it has certainly played that role well recently. Also, alternatives. We've been selectively introducing alternatives into our portfolios. In the managed portfolios, we have allocations to 3 Fidelity Canada liquid alternative strategies. And in the private investment pools, our partnership with Brookfield to manage commercial real estate is a great example of adding an asset class that we think behaves differently. The next thing is currency diversification. We've reduced our long-standing overweight to the US dollar and diversified into other global currencies like the euro and the yen. This is part of the broader view of managing US-centric risks. Ultimately, history shows that while geopolitical shocks cause short-term pain, markets tend to recover. Our job is to ensure our portfolios are structured to weather the initial storm and are well positioned for the long term. We remain attentive and prepared to adjust positioning as needed, but our diversified structure remains the primary foundation that supports our clients and our funds. So while the headlines are concerning, our message is one of discipline and preparedness. Our process is designed for this. Thanks for your time, and please don't hesitate to reach out to your Fidelity representative with any further questions.